Valens Research, Uniform Financial Analytics.
Intuitive Surgical they make robotic surgery equipment. Da Vinci is their most well-known product that they make. And in essence, what it is it is robotic surgery equipment, so you don't have to have a human trying to get into very tight spaces. Specifically, Da Vinci was originally created for urology, was the big area that it was created for. When we get into looking at a company using uniform accounting in the Valens Research app, like Intuitive Surgical, the first place that we always come to is here. We call the PVP chart, which is short for performance and valuation prime. We are incredibly literal people here at Valens. So the reason why we call that is because we're looking at a company's performance historically and forecasted in terms of return on assets. How profitable is this business? How productive is this business? How good is it at throwing off cash flows after it's invested? And profit and performance in terms of how much is this company able to reinvest in its business, or is it not able to reinvest at all? Then we look at valuations, right? Valued asset prime and valued earnings prime, which are uniform accounting cleaned up versions of a PE and a price to book metric. And once we see this, we can see performance and valuation. And the first thing that'll jump out to you here, which is what's so powerful for Intuitive Surgical, is these orange bars. These orange bars are the distorted as reported return on assets for Intuitive Surgical, right? You hear about what we talked about in terms of Intuitive Surgical and what it does. It makes robotic surgery software. Robotic surgery equipment, right? This sounds like a high-tech, innovative company. You would assume that this would be a profitable business. It must have patents that protect its performance. It's also $120 billion. You don't get that big if you just have a generic average product that no one cares about. And yet, I look at the as reported metrics and I see a company that peaked at a 10% return on assets. I guess 16 back here, but look, return on assets has been declining. And last year, return on assets was only 6%. This looks like a really bad business. And it looks like it used to be good, but it's been declining. Well, in reality, what we can see using uniform accounting is everything that causes this company to be $120 billion is because of it actually is a great business. I mean, look at this. This company doesn't have a 6% return on assets last year. Last year, during the pandemic, because hospitals weren't spending a lot of money on surgical equipment, right? Returns were down, but they were down from 47% to 28%. They were still massively higher than as reported metrics, basically 5 times higher than as reported shows you. And they've been that way every single year historically. This company is actually a great business. And you wouldn't have that idea for a moment if you looked at the as reported metrics. Even more so, right? We continue to go down this chart and what we can see is here's the return on assets. Here's the asset growth of the business. Again, we can see the same thing. Here is the as reported return asset growth of the business. And here's the uniform accounting earning asset growth. And what we can see is there are a lot of years when on an as reported basis, you would think that Intuitive Surgical had hit the pause button and wasn't reinvesting in the business anymore, like 2013, 2014, and even 2017. When in reality, Intuitive Surgical has grown more than 10% every single year for the last 15 years. This has been a phenomenal growth story, not one that has an intermittent growth like as reported metrics show. And the next thing of what we can look at is PEs and price to books. So this chart here is valued asset prime, which is our cleaned up version of a price to book metric. And what we're seeing here when we look at that is this company trades at a 22 times multiple, right, on book assets. That's pretty high. That clearly says the market is still pricing a lot of growth for this name. And similarly here, what we can also see is where PEs are. And what's really interesting is if you look here, right now, our uniform accounting PEs and the as reported PEs are pretty close. They're both around 60 to 65 times. In reality, though, historically, this company was a lot cheaper than as reported metrics made it look like they were, right? This company actually, as far back as 2018, wasn't a 40 times PE business. It was a 28 times PE. In 2017, same story. And so we can start to see is not just how good of a company is it, but we can also see how much is the market paying up for that when we're looking at the real numbers. This last chart here is what's called TSRR. For those who don't know, TSR is total shareholder return. Total shareholder return is the total capital appreciation, right? The stock going up, and dividend income you can expect to get, you would have gotten from business any year historically. That second R is relative. Relative to what? Relative to the index. In this case, it's a US listed name, so relative to the S&P 500. When this line is down, like it was here, that means the stock underperformed the market. When it's up, like here, that means the company outperformed the market. When it's flat, like we'll say roughly was here, that means it performed in line with the market. What's really interesting is you look at this company in the context of uniform and as reported metrics, and you can see that this TSR performance tracks a lot more with the uniform accounting data than it does the as reported data. As returns were high and rising, right, TSR outperformed. When returns came down, but the company kept on investing, so earnings kept growing, and then it was basically flat, right? TSR was largely sideways. When the company really started accelerating investment again, right, it wasn't growing at 10% a year, it was growing at 25 to 35% a year, and returns stayed high, TSR took off. And this year, when returns dipped, lo and behold, TSR drops. What's really powerful is when we look at the trends of how the market reacts to the company, it matches uniform accounting data in a very rapid and coherent way, in a way that it almost never does using as reported metrics. All that is great because it helps us understand what is historic profitability and just our PEs high or low. But even that doesn't tell us whether or not we should buy a business, right? Whether or not the company looks undervalued or overvalued. And that's when these last 5 bars in ROA and asset growth come into play and how powerful they are. The 2 light blue bars are what, if we look at Wall Street sell-side analysts and we take their estimates for things like revenue, net income, CapEx, and we push them through the uniform accounting framework, this is what Wall Street analysts are projecting return on assets to be for the next 2 years and asset growth. What these white bars are what the market is pricing Intuitive Surgical to do at a $120 billion market cap and a $330 stock price. So, right, it's not just about is Intuitive Surgical a better business or not. It's also about what is the market expecting Intuitive Surgical to do in the future. And so what I'm going to do is just really quickly here, I'm actually going to adjust one of these things, right? These white bars, like I said, are showing what the market is pricing in. So if I think it's more realistic, the market's pricing in probably something closer to, let's actually say 17.5% asset growth going forward, which is kind of the average of the last 8 years. Well, in that case, for Intuitive Surgical to be fairly valued right now, return on assets would have to get up to, right, all the way up to 60%, levels that Intuitive Surgical hasn't seen since back in 2013. Market expectations, excuse me, for Intuitive Surgical are actually rather high for return on assets right now. And what's really powerful here is using the embedded expectation tool, we can also say, well, so what would Intuitive Surgical be worth if expectations were a bit more reasonable? Like, let's say the market expected return on assets for this business to get to around 50% going forward, but actually for the company to keep on reinvesting at the rate that it has been over the last 8 years or so. What we'd see is if we thought this scenario was reasonable, Intuitive Surgical actually has around, call it 13% downside. If you're even more bearish on return on assets, right, you think it's going to be 45 or even less, then it actually looks even more overvalued. But it's really hard for us to get to a scenario, right, unless we expect massive growth or this company to transform, that we can actually understand that it looks undervalued. And this is the really powerful thing, is these are the kind of conversations that we can have quickly, quite frankly, using uniform accounting, because we know we have the right data and we know that we have these graphics that help us quickly understand what's going on for a business to make those kind of thoughtful conversations with our peers.
Valens Research, the world's leading source for uniform financial analytics.